Out of thousands of backtests, here are the 6 main lessons that over the past combined decade, me and Padma have used to actually make our strategies work live. This topic actually came from a recent post that went viral on Twitter. Someone shared an equity curve that beat the S&P 500 by 2,000 times, and it looked way too good to be true because it was. That's the problem with backtesting. It's incredibly easy to create fantasy results that look amazing on paper, but completely fall apart the moment you risk real money. I've seen it happen dozens of times. Hell, I've done it myself when I was starting out. So today, Padma and I are breaking down the 6 critical mistakes that destroy most backtests, from overfitting to look-ahead biases to poor data. These are the lessons that separate traders who actually make money from their systematic strategies and ones that just have pretty backtests. We're going to show you exactly what to watch out for so you don't waste months or years chasing strategies that will never actually work live. So that kind of leads us perfectly into the first main lesson. Padma, do you want to take it away?
Yeah, sure. So when your backtests, when you see generally, when you see a backtest online and from any place, always assume it's wrong, especially when it's too good to be true. And why? Backtests are harder to do than most people realize. Like a good backtest is much more complex than people realize. And there's so many backtests thrown around and so little profitable traders. Why? Because people think like people make so many assumptions that we're going to go through a few of them in this in today's episode, but they make so many assumptions that it just doesn't translate to life. For example, when stuff is too good to be true, in this specific case, we saw a post yesterday that someone posted about 2,000 times the return of the S&P 500 over the past 20 years or whatever. Straight away, you know that's wrong. Because if you are doing like a 50K or a 10 sharp or whatever it was, like you are not showing that online. You are not showing that online. You probably, if you have a strategy like that, you can do whatever you want in life, right? You can go work for a fund, put that strategy running on capital, whatever. That just doesn't work like that. And you won't find strategies like that also just looking at data. Markets are way too efficient for you to find something that returns 2,000 times the benchmark that you are looking at. So when you see something that is too good to be true, it probably is. Like in most of the times it is.
Yeah, and I would also say just one small nuance on that is that sometimes they can be true, but it's very, very, very low capacity. So realistically, like you're not going to be able to actually size that up at all. So it's not going to be able to make as much money as you actually assume it will. That doesn't happen always. I think it's more the latter, as kind of Pedman was saying, around most people just overfit strategies and then kind of show that equity curve and it looks amazing, but it won't actually work live. But sometimes there's every once in a while you can have something that's kind of low capacity.
Yeah, I'm not saying you won't find those type of strategies. What I'm saying is that you will not find those on a backtest like with 20 years of data. Okay,
Yeah,
because like if you found a 10 sharp strategy like on data that is publicly available to anyone, you really think that you are the first one to detect that on publicly available data? Like no, it, you are not. That with those type of strategies are usually you have to. We talked about last week about what kind of traders there are and what is your edge. And those type of strategies usually fall into the traders that either have very high like computational skills that can run HFT strategies, market making, and those type of strategies usually, if my understanding is correct, because I'm not a market maker or an HFT trader, but they usually don't have backtests. It's very market dependent. Like they are putting their orders based on current market activity. Their own activity influence the market, so there's not really way to backtest that. You know, and
yeah.
exactly.
I,
Yeah,
I
go
I
ahead.
was just gonna add a point. It most of the time for those, like not in all cases, but yeah, as you're saying, you won't be able to backtest them. Sometimes you will be able to model them, so simulate how it would look like if that was like actually apparent and see like the edge cases of it. But that's somewhat different to backtesting because it's not necessarily testing over a ton of historical data. You're more like simulating an idea of how it could work. At least that's what I've seen some people kind of do in HFT sort of world.
Yeah, for sure. Yeah, people model around it and stuff like that. It's just, but what the point is that I'm trying to make is that you're not going to find those type of returns on like daily data over the past 20 years on publicly available data. Like,
Yeah, completely. Or like there's just I think it's from the Law of Trading, if I'm remembering the quote correctly. It somewhat links to this, but he was kind of just saying that the edge is normally directionally or the longevity of an edge is directionally proportional of how complex or how long it takes you to explain that edge. And in a similar sense, like these sort of strategies, as you're saying, you're not going to be able to find them on data that's already available, especially something that's not. How much was it beating SPY by? Did you say 20 times?
No, 2,000 times.
Gee, wow. Yeah, like that's just not going to be a possible thing. I did see his rebuttal, right? Was these are uncorrelated strategies. That is a very cheap way out, and it's definitely most likely, if I had to bet, it's like 99% probably not true, in the sense that no uncorrelated strategies, in the sense of like if you're running, let's say, trend following and mean reversion, is going to be able to achieve you that, because I'm running trend following and mean reversion. There's not that much to it to where you're going to be able to beat it by 2000%.
And it's quite simple to prove that. Just put that thing into the market and let us know how it goes and what is the delta like of the model versus your performance after 1 year or after 6 months. Like, I guarantee you'll find why pretty quickly. But people don't do that because it's easier to sell, like sell the idea rather than extract it from the market. It's like those guys that sell the business ideas rather than making them, right? It's much easier to sell the idea than to do actually the business. So that's the problem with most of these backtesters. It's like everyone, it's like, I think it was Mike Tyson that said, yeah, everybody got a plan until they get punched in the mouth, right?
Yeah.
It's the same idea. Like, you can get all your backtests, but going into the live market with the real cash, you'll find out pretty quickly why that doesn't work.
Yeah, to give everyone that's listening a general idea of how you detect these, I will say it somewhat comes over time of just running a lot of backtests. But the clear things to always look for is, one, if the equity curve has very, very, very little volatility, meaning they have very little drawdowns, and those drawdowns are often really quickly recovered. And two, if it's basically like a straight line to the right. If it's doing both of those things, it's most likely overfit. There's either a bug in your backtester, some assumption that you haven't actually taken incorrectly, all those sort of things. And yeah, that's normally how you detect it. There are a couple of other ways, but obviously if something's really outperforming SPY like that, that's also a big sign where I'd want to double check and triple check everything to make sure that my assumptions are actually correct. And also, as you were saying, just maybe test it out live on small size and see if that still kind of plays up. And that's how the main ways you can detect it and test it.
Yeah, and it's really hard to tell you how to know if a type of that backtest is wrong. It's yeah, you can run all the simulations, think about it, but it's really hard until you have that experience of actually going into the market and putting it there.
Yeah.
And you'll find the answers there pretty quickly. The market is the ultimate test, right? We are here to make money, make returns, to make better risk-adjusted returns at the benchmark, and the ultimate test is the market. There's no way around it. You can run all the Monte Carlos, all the whatever you use for robustness, but at the end of the day, the market will tell if you are right or wrong.
Completely. I guess that brings over to the next main lesson. This is sort of combined, so it's mainly hindsight and look ahead bias. So hindsight is kind of like if you only deployed a strategy on NVIDIA and you deployed a strategy that was on breakouts of highs. Now, obviously, over time, that is going to look like an amazing strategy, but that's because you already have the hindsight knowledge of knowing that it works on NVIDIA. Now, some people sometimes get like this kind of confused, meaning that, well, does that mean I should include NVIDIA necessarily in my trading? No, you'll just know that it's always going to be a big winner, let's say if you're running a basket of stocks. But if you just if you test a strategy just on NVIDIA and you're just testing long only and stuff, obviously it's going to perform and outperform SPY because you can already have seen it, already known it. If you want to explain look ahead bias really quickly, Padma.
Yeah, for sure. So definitely, if I can add to the hindsight one that you said, for example, I saw a trader talking about running like a BTC only strategy on the long side. That is probably an idea that will pay out. All right, like it's BTC will probably be around. It'll probably be an institutional asset because it's getting that institutional adoption, that ETFs, governments, whatever. But you are always having that bias that it was the asset that actually performed, that actually survived all the crypto madness right over the past decade. So you are making even if you don't want to, but you are making a bet that BTC will be the dominant asset going forward in this example of crypto. And that inserts a certain hindsight bias, because if you go back and say, oh, I could have made whatever 3,000% with this strategy trading BTC long only for the past 10 years, sure, but is it reasonable to assume that you'd be trading as the BTC in 2013 or 2016 or whatever? So a better approach to always remove hindsight is to keep your universes flexible, right? For example, saying, I'm not trading BTC, but I'm trading the top 5 by market cap. And you adjust that universe every day, every week, whatever. And you take, okay, what is this week's, this month, like top 5 by market cap? And I trade those. And so your universe is always flowing. Even if BTC in 20 years would fall off that list, you'd still be trading the top 5 back then. And then you like neutralize that bias, basically.
Perfectly put.
Yeah. So in terms of look ahead is a bit different, and it's a common mistake that people that are not very experienced with backtests do. For example, how can I give an example? Okay, let's say you are. Yeah.
I just had one on top of my head if you forgot one.
Please go.
The main one I always see, it always sticks with me because I've seen it on so many like codes people have sent over, is if they're using data from either the close of that day or of the next day. So they'll be simulating something that they're going to take a position at open because of the data based on close or based on the data of the next day. It's the most obvious look ahead bias because a lot of people forget that you have to think of point in time data, and that's the main way you get around and like actually not do look ahead bias, is just think what data would be available to me at that time of entry or at that time of scanning, all those sort of things, and then you can kind of go backwards from there.
Yeah. I'll give one simpler and then I'll give one more complex as well. For the simpler is, imagine like you were saying that you were using the open bar for your signal. So you use the open for the signal. Let's say that you do open above like Bollinger Band, whatever. If you do that, you are basically using information, the Bollinger Band on that day, that it doesn't exist yet. You have to look before because the Bollinger Band on that day hasn't closed yet. Or if you're using like the close price, what was one? For example, when I was testing small caps strategies and I wanted to see, I want to see by 11 a.m. or whatever, the close has to be below the high or something like that. You don't know the high at 11 a.m. of the day, right? So you kind of have to go into the data and calculate the high up until the point of 11 a.m. But many people that are not experienced in this will use the high of day before they make rules with information they don't have yet. This is especially more important in intraday strategies if you are using them, because stuff moves a lot during the day, right? You can have a high of day at 4:59 p.m. or you can have a low of that at 9:30 a.m. Right? And so you have to be always considering what kind of information you have at that specific time in the day, and that's very important.
Yeah, perfect. The next one is survivorship bias. That's primarily just the classic example, right? Is that a lot of stocks get delisted. So if you're not including stocks that got delisted in your portfolio, whether that be from stock selection or scanning at that point in time when they were actually listed, you're already making the simulation better than what it would have been because they would have traded those delisted stocks most likely. I don't know if there's actually a clear example of this in crypto. Do you have one, Petma?
Oh yeah, we do. I actually had to work around some of them. So the providers now that include a lot of delisted stock from exchange, cryptos from specific exchanges. For example, you have Tardis, which is a data provider that provides data, for example, for Binance, for all assets that were listed there, but that got delisted or something. There's a lot of crypto assets that get delisted all the time from these exchanges because they either are known scams or they get lower liquidity. Whatever happens on the back end of the exchanges, they get delisted. And and you can get that data, but that data usually is expensive. Another way you can do that is to collect data all the time, right? You are always collecting data into the database and storing them over time. So even when it gets delisted from Binance, for example, you still have that data stored there. And I was actually working through a problem on my own codes this week, which was exactly that, because there was an asset that during 5 or 6 days, they got delisted and then they got listed again, or whatever happened on those days. You have a gap in the days. And so you have to always be careful about those, because if you have a position on, which I did, like your code will break or will make assumptions that don't exist because we have a gap in there of a bunch of days that don't exist. So you have always to be considering those days as well included. If I'm sorry if I'm making a mess here.
No, it makes sense. I completely forgot that. Obviously, yeah, exchanges delist in crypto as well. So you have the similar sort of issue.
The next most common example is, okay, you get the backtest of a simple trading strategy, right? But you want to make more money. Like everyone is here to make money in trading, right? So you start digging, I'll add this filter. Oh, I see that it doesn't trade well when whatever it's below the 13-day SMA or whatever. And you start adding all these filters, then you become a bit more sophisticated, you go add machine learning into it, and you start testing a bunch of parameters to see which model becomes the strongest model, the model that produces the best returns. And it's there where many engineers and people with a statistical background, like a more academic background, fall into is the over optimization, overfitting, or data snooping. There's a bunch of names to it, where you start digging the data, beating the data into submission until it gives you an answer that you want. And that is wrong. Because consider this, every time that you add a rule, you are saying that rule, you are betting, you are making a bet, we are making an assumption that in the future that rule will remain the same. That statistical relationship, which is what is called between forward returns and that rule, is going to remain always the same, or it's going to give you the same degree of edge. And the markets are always changing. These things are always breaking. Statistical relationships break all the time. That's why you see people say so much that markets are always changing. And it's true, nothing is stationary here. And the more rules that you add to a model, or the more that you dig into the data, the more that technical debt that you add to your model, you are adding on the back end, and it's risk. And when you put your model live after a bunch of over optimization, you'll find out maybe it works for a while, maybe it doesn't, probably it won't in a year. Okay, because you over optimized. Usually what's best and what we do is understand the effect that you are trying to harvest the best, and then put the simplest model possible, or a composite of signals to harvest that effect. We don't try to optimize our backtest so that it produces the best returns. That's a very big pitfall, and that many people fall into.
Yeah, I think that's put perfectly. I'd also say one that I kept on hearing over these kind of like free calls I did. I just sent out an email to kind of like schedule a call with me just to chat. Because I always like kind of catching up with traders. And the common one that I always heard around backtesting was everyone wants more trades. A lot of the times it sounds really ironic, right? But a lot of these traders had a strategy that worked, but it just had kind of low frequency. Maybe it only had 100 or 200 trades overall every year, give or take. Maybe it's a swing strategy, so maybe even less. And they just wanted more trades from it because more trades means more account growth, more compounding for the most part, etc. It means also more opportunities that they can trade, and like it fixed that kind of itch. And so many people approach this via, I'm just going to tweak this strategy more to use it on a lower time frame. I'm going to tweak the parameter values to make it more profitable and have more trades kind of from it. And that's only going to lead to one thing, and it's because it's going to lead to overfitting. And as you're kind of saying, if you have that main objective with you just want the highest returns possible, you want the most trades and the highest return as well, like it's just going to always lead to overfitting, and you're not going to have a great experience when actually taking that live. A better approach, at least in my opinion, is let's say you have a swing strategy, it's working kind of well, but you're only applying it to a couple of assets. Maybe try applying it to other markets. Maybe obviously add maybe new strategies. That can be a way more reliable version to add more trade frequency if that's something you really want. But I would never just try and approach backtesting from the sense of I need the highest return on this, and that's how I'm going into it. Many times, at least for me, when I'm backtesting a strategy, I'm always starting with a hypothesis or an idea that I want to test, and then from there, all I'm trying to do is prove that idea or strategy incorrect. And if I can't, then I know that's a really solid strategy, and that's something I could probably take live and actually test.
Yeah, 100%. There's much. I understand the lore of that. I understand what catches people attention is that it's that thing of trying to find that holy grail, right? Try to dig,
Yeah.
dig, dig until you find gold, but that doesn't really exist in financial markets. And don't take our word for it. Go test and put, like we say, try in the market, and you'll quickly find out what happens then. Yeah, right. So,
Yeah, completely. The next one is poor data is more common than you think. Now, I'll put this with one big kind of like, I guess, nuance. If you're doing like daily strategies for the most part, a lot of free data for daily strategies can be somewhat decent. Depends on what you're like testing over. But even Yahoo Finance, while it's not perfect data, don't get me wrong, there definitely is issues with it. Sometimes it can be decent if you're just testing over like a couple of stocks. But one thing I'd always recommend for any systematic trading is investing in your data, whether that be investing into a good data provider, spending more time on it, because all of your assumptions are being based on this data alone, right? So you want to be able to know that this data is quality data, it makes sense. You want to triple check it. And also, this is why whenever I see people going to these really low time frames for testing, it's just so much more of a headache. There's so much more you have to test. There's so much more data you have to handle. It's so much more competitive as well. It's a lot harder to find really an edge with it. And most of the time, your backtesting is going to have some wrong assumption, or there's going to be something you've missed. So I would always start on a higher time frame, and then if you really, really want to test low, go lower and test lower and see how it kind of works. But definitely invest in your data. It's something that I wouldn't say it's ever worth skimping out. Obviously, there's limitations of this, right? Like trying to find a good deal, but especially if you're not paying non-professional fees, like I would always say it's worth buying some solid data if you can.
yeah, I remember spending my first, like my first time I spent money on data, and it was a big deal because when you're
Yeah.
starting out, you're starting out in trading, you're always like, you know, not all of us have had a lot of money, and we start out saving everything we can. Even the trading view subscription was something. Oh, damn! I have to pay $300 now for the year or whatever, like on the Black Friday sale. And like I remember, I think it was Norgate data, which has survivorship bias data and stuff like that. It's pretty. I think it's pretty quality, but I'm not a stock guy, so I won't comment on that. But Norgate data had, and I think it was like $700 or something like that for, I don't know, 20 years or more of data. We saw stocks that are delisted and listed and a bunch of stuff, and it's like $600. I understand it's money, and it's not something that it is cheap, but if you understand that this is your business that you want to do, that's just the cost of doing business. It's like buying a computer or a laptop for another business, or a printer or something like that, right? You have to invest in your business, and if you're going to make decisions based on data, you better be sure that you're making the highest quality decisions.
Yeah, completely. I'd also say I've always put it in this perspective for myself. I will say I've gone through the same thing as you. Like I remember the first time I paid $200 a month for live Polygon data. That was a shock to my system because like I was profitable by that time, but it was still like, oh my god, I have a $200 commitment like every month, and it's not anything. It's just data. That's it. But I will say, when you put it into perspective of how much you lose in trading, whether that be because of stupid trades, whether that be because you have bad data and then you actually lose on a strategy because you didn't backtest it correctly because you have bad data, all those sort of things, you'll often lose so much more money than if you had just invested in the quality data or whatever. So that's at least how I try and look at it nowadays, because it's always a long-term investment. It's always going to save me money that I probably won't ever notice that I'm saving, if that makes sense.
Yeah, like consider like how many like strategy I put on it. At the beginning, I lost, not lost, but deposited. Before I turned profitable, I deposited like, I think it was a total amount of 20,000 euros or something like that into my trading accounts, which a lot of it was lost back then. And it's like, when you put into context that okay, maybe investing in this data source or that like education or whatever, like puts it into context. Okay, it's not that like I'll play to the market anyway, so better have the most quality stuff to give me the best chances to do this business.
Yeah, completely. Last one. I know everyone's gonna sigh when they hear this stuff, but still to this day, and even from these calls that I kind of took, no one likes applying fees, costs, and slippage, and like market impact or just general assumptions into the backtests. The first question I ask pretty much everyone, especially if they're like a software developer or maybe they've come from some sort of coding background, they'll say, "Oh, I've coded up this backtest," and I'll be like, do you have fees and costs like in slippage in this? And they'll be like, nope, I don't know. I'm like, well, then it doesn't really matter what you're backtesting on this. Like, unless you're backtesting something that's so low frequency that no way commissions or slippage is going to hurt it, like most of the time there will be a negative effect by applying those. And it'll be something that you want to pay attention to. If you're doing anything sub daily, you want 100% to have decent fees and slippage applied calculations on your backtest. Otherwise, you're just gonna be testing stuff. It's gonna look great. You're gonna put it live, and you're gonna be like, "Oh, this doesn't actually work because I have fees and slippage that you have to apply to it." Above, if you, especially, I will say the only small exception to this is if it is a strategy where you are maybe trading $2,000, let's say. For the most part, fees and slippage isn't going to affect it too much if it's a low, kind of low frequency strategy. Let's say you're taking on a daily strategy, and that's fine if you're just getting started and you're slowly building up your backtester. But once you start, getting into 10, 20,000, whatever, and above, you definitely need to be making sure that you have fees, costs, and slippage on your backtest, even if it is a basic assumption where you're just saying you're going to apply a percent of slippage or a tick of slippage or whatever it is for your particular market. But the base mechanism, I would say, especially because it's very easy to code, is just adding your fees. How much does it cost you to place a trade? And just make sure you have that.
I still remember the days that actually that $2,000 example would actually be a problem, because remember when we had to pay like $6.99 round trip, like each direction.
It's actually true. Yeah, I do remember back in the day. Like, I remember I had, yes, what was it on? I think it was on Trade Zero back in the day. They had way higher commissions if I remember correctly. I think I was paying like $5 per trade, like minimum.
Exactly. Yeah, me too. I think at one point I was paying $9, if I'm not mistaken, something like that. But you would have to pay like those. If you had more than 200 shares, you would pay on a share.
That's what it was. Yes.
Yeah.
If you had, and because if you're on a small account, you're fucking paying at least $5. Yeah, it was tough. That is a good point. That's why I kind of try and put the stimulation if it's anything that's below daily. If you're daily, apply this. I will say people are somewhat luckier now because obviously you have some brokerages that are low commission or no commission, sorry. But the one thing people really overestimate on those is that they won't have any slippage or anything. Most of the time, I'm not going to say this for everything, but most of the time, the ones that have no commission are often taking you based on slippage. So.
And people are assuming on the backtest like they get executed at the last price.
Yeah. So those are our main lessons. I think if you apply all of them, you probably will save at least a couple of months, maybe a year, depending on how long.
And don't forget it, like you were saying, like as it scales size, the lower the frequency, like of the time frame of whatever the view on the signal that you have, like you are going to be impacting the markets. You have to think like, what kind of assets are you trading? Do they have liquidity on the book to absorb your position? Like you are really going to make a backtest on 1 minute candles saying that I'm going to execute $1 million position at the closing bar of that minute candle. No, you're going to pay a very high cost for that. So you are not going to execute, you're going to impact the market. Imagine this, like the close price of that candle was $1 back then. But if you had that $1 million back then, it wouldn't no longer, and you executed a position there, it would no longer be $1 close. It would be much higher because you impacted the market and you moved the market a lot. So market impact is very hard to estimate and something that is very important as you scale size. And you see these backtests, I turned $1,000 into 25 million trading small caps on these backtests. Yeah, sure, buddy. Probably the backtest is wrong, but let's say that it is correct. If you go above a certain, like 100,000, you already getting into problems. So
yeah, completely. Well, I'll leave it on this because I put a tweet out a while ago, and I thought it was going to go somewhat viral, but I forgot that no one really likes talking about costs and commissions and stuff. But Jim Simons, on one of his interviews, said that the model code was, decently complex. I assume it was still, quite complex, at least compared to anything we're running, right? But he said the most complex element was the commissions and market impact simulations. And it's like, yeah, because those sort of things, it's very difficult to have solid code of making those assumptions.
Yeah. How like that data is available, but it's super hard to estimate for that, because it's not a stationary thing. I'm going to take these orders out. No, these days the market makers adjust their positions like almost flow with the amount of flows that are coming into the market, and it adjusts and rebel. it's so dynamic, so it's hard to estimate, but it is something that you find out when you go live and you start measuring these things.